Hi class. I wanted to give you a little introduction that goes along with chapter 4 in learning about our accounting cycle. And what I want to do here is just distinguish between our general journal entries, our adjusting journal entries, and our closing entries. So let's just start with an overview of general journal entries. The purpose: to record day-to-day transactions. Okay, they often involve cash. If cash is coming in, we debit. If cash is going out, we credit. Often these are started by a source document. So if something triggers the accounting information system, we have to record something, and so it gets put in. Adjusting journal entries come at the end of a period. And the reason we have adjusting journal entries is because we use accrual-based accounting. There's two main purposes here. In the first, record expenses and revenues in the correct period. And then the second, and we do this together at the same time, we get our assets and liabilities at the correct amount. And so what I want to do is just show you what this means. Let's say this is our period time. Sometimes we might receive cash ahead of time, maybe in a prior period, for services that we render during this period. Accrual basis accounting says we need to go ahead and record the revenue in this period. So what might have been unearned revenue back here when the cash came in is then treated as revenue during this period. Another thing that might happen is that we have expenses and maybe we haven't paid those yet, but they were associated with this period. So maybe we're going to pay them in the next period. So what we're going to do is maybe show that we have incurred an expense, for example, salaries, the last week of the year. We haven't necessarily paid our workers for that week, but we have to go ahead and show the salaries expense for the entire year, including that last week, even though there's not been a source document, which would be the timesheet, let's say, that has come into the system and said, oh, time to do that entry. So that hasn't happened. So the adjusting journal entries require extra thought. And so that is kind of why they are the hardest of all the entries that we have to do. And don't worry, all students struggle with adjusting journal entries, from non-business majors, business majors, and accounting majors. So hang in there. They get easier as we go through them. The last type of entry is called the closing entries. And again, there's two purposes here. We want to close out any temporary accounts, and we want to update the retained earnings account. And we don't know yet about the AOCI account, which stands for Accumulated Other Comprehensive Income. We're going to learn about that in a future chapter, but it is similar to the retained earnings account. So I just put it in here to be consistent, okay? And with closing entries, we basically have the four-step process. You close your revenues into income summary, your expenses into income summary. You close your income summary into retained earnings, and then we close out dividends. So that's a little overview of the three different types of entries, and I hope this clarifies a little bit, and then we'll have some other videos on how to just do more on the adjusting and the closing entries. Thanks, guys.